I'm Joshua Freedman, Senior Analyst at Rapaport, and welcome to a special Rapaport Diamond podcast in full video format. Our guest on this episode was Eyal Axelrod. Eyal headed the Israel office of diamond broker iHenig for 18 years before moving to Lucix, a producer of lab-grown diamonds. He left Lucix in 2023 to set up Lexa consultancy, which provides advice to companies in both the natural and lab-grown sectors. Eyal and I spoke about how his background in the movie industry informed his understanding of the diamond trade, as well as the future of the diamond industry and trends in the rough market. Enjoy the episode and let us know what you think of this new format. So Eyal, welcome to the podcast. We're going to speak in due course about some of your previous high-profile roles in the industry. But to begin with, can you tell me a little bit about Lexa consultancy? What is it?
Well, thanks for having me, Joshua. It's great to be here. Lexa is a consulting company with vast experience in the diamond industry, focusing on the entire pipeline from retail to mining to the producers. I have 20 years of experience in the diamond industry, and my team has experience in business development and also in strategic consulting for large corporations. And when I opened Lexa a year and a half ago, basically, we already saw the changes and the fundamental changes we're experiencing today in the past year. And I think that when you are looking at the industry and you can look at the opportunities together with the challenges that are there, I think we are in the right place in the right time to grab those opportunities. And that's what Lexa is about, to work together with our clients and together with the industry in order to look at the future where we're going and to try and help bring people together, bring companies together, connect between businesses in order to create the value they need to go to the future.
So you provide consultancy services to the whole pipeline from mining, midstream, retail, and natural and lab grown?
Yes, so we'll talk about probably, but we have very good experience also in the lab grown space because of my background. And so yes, we consult retailers and brands. We are a De Beers broker, so we also work with sightholders in the De Beers system. That is my experience in the past. And also we consulted in the past year, we worked with ODC, the government of Botswana, in order to work on their strategy for the future of their business. And I think when you look at the entire pipeline, obviously there is the whole midstream of manufacturing, which is the core of the industry as we see it. But the companies that affect the everything that is going on is in both ends of the pipeline. It's the retailers and brands and the producers. And we need to look at it as a three-way type of system that we need to connect and work together with. And yes, in the past year, we've worked with all of those entities in the midstream.
And previously you were at iHenig, the diamond broker and consultancy firm for, close to 20 years, right?
Right. So actually previously, before Lexa, I was at Lucix. But before that, I was at Hennig. Yes, I started the industry in 2003. Before that, actually, I worked in the movie industry in Los Angeles. And I must say, when looking back, the movie industry, I was a creative executive and director of development in the studios, and was developing scripts and working with directors and producers and agents. And I must say that looking back, the industry of the movie industry is very similar in ways to the diamond industry. Why? Because both ends of the business control everything that is going on in the middle. So you have the studios, which are equivalent to the producers in our industry, and you have the cinema chains, who are like the retailers in our industry, and they control everything that's going on in the middle. And there is thousands of people in the middle who are trying to create value and trying to be creative and trying to look at ways that can make a business for themselves creatively. And if you look at the diamond industry, it's pretty much the same. I came coincidentally into the diamond industry. It wasn't my background, but I was at Hennig 18 years. I managed the Israeli office for iHenig. I worked with many companies throughout the industry, international corporations, retailers, very large retailers, but also, of course, diamond manufacturers. And obviously, I created a very strong relationship with De Beers, and I know De Beers very, very well from regarding their corporation, their way of doing business, and of course working with various elements inside the beers, not only the sales part to sightholders. End of 21, I saw the vast changes that are coming into the industry. Lab-grown was exploding. It's a very interesting business as it is, and I think it will be studied in business schools in the future because it's what we have experienced in our diamond industry in lab-grown in the last 4 years is really interesting, I would say. But it's affecting our business tremendously. And when I saw that, and when Lucix approached me, it was a very interesting opportunity. I didn't feel I can add value to the industry, working in an environment that is 120 years old, very traditional. I wanted to look forward and do different things. And when Benny Landa and the CEO of Lucix approached me, I decided to grab that opportunity. I was VP of Sales and Marketing for Lucix. And actually 3 months after I started, we raised $100 million for the business. Lucix was sold a few months ago to Phoenix for $4 million, which is a big shame because Lucix had tremendous opportunities. But I think the greatness of Lucix is what basically at the end made it, it was sold, is because of it was a technology company. It was an amazing technology company. They reached the technology first in the world regarding high quality rough diamonds of lab-grown. But as a producer, a technology producer, they looked at technology to create value and create the cost. No one took into consideration how fast the Indians will reach the same technology. And when they did, we all know what happened. Prices started decreasing. It was much faster than anyone expected. And when I saw this happening very quickly, and I saw that it would be very difficult to change the future of Lucix, I decided to leave at the middle of 23 and open Lexa. I stayed as a consultant to Lucix until actually it was sold to Phoenix a few months ago. So I was very much involved in the company until the last minute.
So when you joined Lucix from Hennig, my first thoughts were that this was this reflected the shift in the market from natural to lab-grown diamonds. And then when you left Lucix, I felt like it reflected the shift back to natural. In terms of your journey, could it be that Lexa now is a bit of just a compromise between the two?
I wouldn't look at it as a compromise. Actually, I saw an opportunity, a very big opportunity, because you have lab-grown, you have natural. They're both fantastic industries, and I see a future for both, by the way. It's still unclear. It's still a gray future for all of us, but there is a future there. And actually, after studying and learning the lab-grown industry and knowing it very well from producers to retail, because I worked with many retailers also in the lab-grown space, then I saw that Lexa can take advantage of the knowledge and experience we have in both worlds in order to help many entities in the diamond industry cope with these changes. Now, whether you're natural or in lab, both parts of the industry need to understand the other part and need to know how to work in that space. And actually, I'm very optimistic on the natural diamonds going into the future. But obviously, there's a lot of changes that we'll talk about that are happening now and will affect the future. So when I envisioned Lexa, it was actually to take all the changes, find the opportunities and the experience we have, because there's not many I would say, neutral executives that have experience in both worlds. So, and that's what Lexa was about. And obviously, going back to my what I know best when you wake me up in the middle of the night is the beers and being representing sightholders. And when sightholders, there was an opportunity to represent some sightholders with the beers, I decided to go back to the core, as I would say, taking into consideration my additional experience in lab-grown.
So going back to the film industry, you mentioned there was a squeezed middle there, a bit like in our industry. Did members of that industry ever find any solutions that worked?
regarding, it's very different in the sense that disruption, like lab-grown is doing in the natural world, happened in the movie industry when you had Netflix, when you had digital, basically streaming coming into place. And the studios were very, very nervous on how the industry will be changed, and they will lose a lot of clients, basically. The people want to stay home and watch a movie at home. But actually, history shows that the opposite has happened. Actually, at the end, people love to go to the movie cinemas. They love the experience. Movies is like diamonds. It's a dream, right? You go into a different world and you imagine something, and it affects you internally, whether you're happy or you're sad or you're. And I think the studios and the cinema corporations worked very hard to create a better experience, to create to get the family to go out as a whole experience for the family. And eventually they saw that people love to go out. People love to go see a movie in a cinema and not necessarily seen home. And today it's flourishing, the movie industry in cinemas. But it took time. At first, it was a problem. It was and all the studio heads were sitting and boggling their heads, what are they going to do with Netflix and streaming videos? So we see that if you look at the consumer, at the end of the day, we're all here because of someone buying a diamond, someone going to the cinema and watching a movie and paying the dollars they need to in order to get that product. It's about the product, it's about the experience, about the psychological effects of why they're buying that product. And all of us need to remember that when we make business decisions in our industry, especially when we talk about lab-grown and natural. So yes, I think the movie industry coped with it. They continued making exceptional products. They continued looking at the consumers in order to give them what they need and provide content that they're looking for. And maybe, and even though Netflix are doing an amazing job there, and they're a very successful company, you still have the studios who are making traditional movies in cinemas in a very successful way. If I look, again, if we parallel that to our industry, lab-grown and natural can have great businesses in parallel. Doesn't have to take one another business away from each other.
Right. Now we're recording this in the last week of 2024, in December. 2024 has obviously been a difficult year for the industry in a number of ways. So how was 2024? What were the main trends that characterized 2024 in the industry?
So one of the things we're working on is we're working with the retailers and brands in order to bring them upstream and educate them on the upstream changes strategy. And we believe that bringing the retailers and brands and putting them together with the producers is the right thing when we go into the future. But when I start the presentation, when we have the first meeting and I start the presentation, the first slide says that 2024 is the most challenging year in the history of the diamond industry. And I really believe that, and I think many people would agree with that. It's been a very, and I must say, someone told me this week, it's not a crisis. A crisis is when you have a downturn, people lose money, it's very difficult, but it's a cyclical. So we get out of the crisis and we go back to the good days of making good business and profitability. I think this time it's not a crisis. It's a fundamental change in the industry that we are experiencing, and we're still in the midst of it, that will change the way we need to do business going forward. So the main things that happened in 2024, we had COVID, and after COVID, everybody experienced an amazing 21, and half of 22 was really, really strong years. But as demand started going down, I think the whole kind of, so two things happened, I think, in the last few years. Demand started going down after COVID. They bought a lot of diamond jewelry, but then it calmed down. But lab-grown went up. And lab-grown is growing. The consumers love the product, especially millennials. They go into the stores and they bought lab-grown in very large amounts. And that definitely affected the demand for natural diamonds. Now, obviously, this was a thing that happened because of a push, not a pull. The consumers 5-6 years ago did not even know what lab. Some did know about it, but they didn't know. But retailers were really making a very nice profit on the lab-grown business, and they pushed it to the consumers in the retail stores, online, and so on. And this created the biggest problems that we experience today. You add to that China, obviously, we all understand what's happening with there. Basically, it was a very big catalyst for demand, which is almost done. There's almost no demand coming from China. And you put the economic situation of the whole world, especially the interest rates. So if people would hold stocks in the past, there would be zero interest rate. It's okay to hold a stock, and even if difficult times. Today, it costs them a lot of money. And that creates a lot of problems that we experience, especially in 2024. And if I look at the main things in 2024, revenue is down in the midstream. Most manufacturers, I would say, the revenue is down by 40, 50%. And it's not because on the retail level it went down that much. We all know it went down 8%, 10%, but the retailers and brands decided to reduce their stocks, to see where the industry is going, to see where the demand is going in their stores before they restock, before they start purchasing again from the industry. And we all know that when this happens, there's price reductions. And when there's price reductions, the stock levels are being, are basically people's own money is being destroyed because the stocks are worth less than what they were when they purchased them. And also the expenses are still very high because people don't reduce expenses immediately if the revenue goes down. So people are experiencing very, very difficult times. And I must say, it's everyone. You have producers, manufacturers, and even retailers. Everybody are experiencing this year as one of the most difficult years in history. Because if you look at producers, obviously they have rough to sell, prices are decreasing, they have huge costs to extract the rough from the ground. They have to invest heavily in the mines to continue extracting the rough that they need from the mines in the future and to create the value that they need. But in a downturn market where prices are decreasing and demand is very low, it is very difficult for them to sustain their business, to manage their business, cash flow and intake. You look at manufacturers, obviously their stock levels have, are worth much less than they were before. They're not selling, expenses are high, they're experiencing a lot of problems. And you look at retailers, I think that's where we see much more of a problem between lab-grown and natural. They're really looking at the lab-grown as a great business because they're still making a nice profit as prices are holding in the retail level. But they need the natural business in order to sustain the business, because when you sell a lab-grown, as prices do decrease in the retail level, you have to sell more pieces in order to reach the volumes they need, even though the profit is high. But still, monetary-wise, it's not a lot of money. So you need to sell a lot of pieces. To sell a lot of pieces, you need marketing, you need sales, you need logistics, you need much more of expenses. And that is something that the retailers are very struggling with. And you see companies like Signet shifting away from the lab-grown story and pushing to consumers, going back to natural and building that story to consumers back. And obviously, we know that Signet and De Beers have come together in order to build a marketing campaign for consumers, because the both ends of the pipeline see that they need to work together. And this is what also I believe is the big opportunity in our industry, that if you bring both ends together and you make sure that they both understand each other much more clearly on what's going on in our industry and going forward, and not each entity focusing on their own side, I think that will bring more value. I would add to that, of course, is the whole De Beers and Botswana story. Obviously, De Beers have announced that Anglo American wants to sell De Beers. And we all know that the De Beers and Botswana government contract hasn't been signed yet. And this creates a lot of tension, a lot of psychological effect inside our industry, where people don't have a clear understanding and confidence of where the future is coming. And until we see those two elements stabilize, I think it fuels all the problems that we have in the industry, it fuels the lack of certainty and the lack of confidence. But I think that once the beers signed a contract with Botswana, which is very important for both entities, we worked very closely with the government of Botswana and with ODC in the last year, and they are geared and ready to move forward and with their strategy of increasing the rough intake and their sales strategy, but everything is on hold until that contract is signed. And the beers are obviously, they want that contract to be signed in order for them to move forward with their strategy of selling the beers. And so I think that is a very strong catalyst also to what we've seen in the last year.
Would you say that the downturn of 2023 and the downturn of 2024 were largely for the same reasons, just a repeat?
Yes, I think in 2023 we started seeing what we're seeing even more in 2024. And I'm sorry to be a bit pessimistic. I don't think it will end in 2025. I think we're seeing a fundamental change where demand for natural in the retail space is going down, and the industry should come together, and they are doing elements we saw in the Dubai conference where the World Federation of Diamond Bourse were talking to collect much more money from the industry in order to promote natural diamonds to consumers. But there's many other things that I think the industry should do in order to promote natural. But obviously origin and provenance is an important element of it. But when you take 24, I think also the increase in the economical uncertainty of the world increased. Interest rates were still very high. It started 23, but it's 24. It was still high. Also, you had elections in America. China is still, as long as China stays as a, I would say, a non-market, then the problems just grow. Obviously, people need to change their whole way of thinking. Now, when a crisis starts, when it started in the beginning of 23, people are still hoping or thinking that at the end of 23 or beginning of 24, we'll see better times. But I think in 24, people understand that nobody should wait for better times. They should change their own business. They should really look at the business with open eyes and look at opportunities and change their strategy in order to get out of this. But if people, stay on doing the same thing, I think they better preserve their money and and do something else maybe. So,
isn't the hard truth that really the world needs 30%, 50% fewer diamonds than it did in the past, and therefore the industry, at least the midstream, needs to downsize to adapt to that?
Well, I don't know about 30, 40%. I don't know if anyone knows that number. But obviously, throughout history, we always had a bottleneck. So always the industry would hold large stocks of diamonds, whether rough or polished, and we'll sell them to the retailers as demand was there. Now that bottleneck was okay because people hold stocks, large stocks in diamonds, and interest rates were low, at least in the last 15 years. But even if if you look at pricing of diamonds and look at, again, the cyclical aspects of our industry, it would be worth it for them to hold those stocks. Because eventually, when the market had a upturn, they would sell that stock, make that profit that they need in order to justify holding that stock for years or the losses that they made 2 years before. That is, I think everybody understands today that is not a good strategy for anyone, not the midstream and not the retailers. Who is suffering from this, I think, is more the producers, because it's more difficult for them to sell the quantities of rough that they were used to selling. It's not that demand is not there. I was just in Dubai last week, and there were hundreds of people waiting in line to go into the tenders and buy rough. Pricing is always an issue, obviously, but there is demand. But how big of a demand? So even in the past, the beers would not sell 6 months. The beers under Rosa in the past would not sell for 6 months. It would dry the market, and you would see a big hunger for diamonds, and then it will start the cycle again of going up. But that's not happening. De Beers had very low sales in the last 6 months. They're actually trying to protect themselves, but also protect the industry, but not pushing huge quantities of rough into the market. ODC canceled the last 3 tenders. Alrosa, even though they have their own problems with the world, with G7, but they are selling their diamonds, and they also stopped selling. So basically, you would think that the market is drying up, and we will see strong demand. But Angola and the rest of the market, who have continued to sell large quantities of rough at the market price, which some would argue is 15% lower still than some other producers like De Beers and ODC, would be sufficient for the demand there is. And that goes back to what you said. So I don't know if 30-40%, but obviously the amount of rough coming out of mines in the past few years is too much for the demand that we have today. Now, if in 5 years, let's say we put huge marketing amounts, the industry, huge marketing efforts into natural, and demand will start going up again, and lab-grown will disappear, let's say. I don't believe that will happen, but let's say that will happen. Then I think the mining would be fine, and all the rough that is coming out is right according to the demand. But we know that that is a very optimistic look, and that's why all mining companies have already said they're going to reduce production going forward. And in the current pricing, and in the pricing that I see that we're going to, I think there will be some mines struggling to sustain themselves. Some mines are expensive, and if this continues, we will see mines close. We will see less supply coming into the market.
Talking of downsizing, just yesterday the news came out that AMC Group, a rough buyer and polish supplier, was going to be sold to Choron Group, a rival company in the Antwerp diamond industry. Do you think this could be a precursor for further consolidation in the industry?
Yes. First of all, I think it's a great deal. I think it's a great deal, not so much for the 2 companies that made the deal, which I'm sure I don't know the details of the deal, but I'm sure they made a very good deal between themselves. But I think it's good for the industry. We were involved with also selling a small diamond company about a year ago. They were interested getting out because, of the industry. And in the past, it was very, very difficult to sell a diamond company because diamanteers used to hold all their knowledge and expertise with themselves. They will have the contacts. But I think today you see more and more companies building their business, not based on themselves, but based on actual product, service, and business orientation. And when you have you build such a company, then you can actually become like a regular business in the outside world where you can sell the company and you can merge and you can do exceptional things. And I must say that it's a great deal because it shows to the industry and it shows to the outside world that the diamond industry is changing, the diamond industry has opportunities, and people should actually think of where's my value. How can I get more value by either merging with someone else, being purchased by someone else? And I think for many companies, it's a great opportunity if they do things correctly. Obviously, everything in our industry is very discreet. We put on our banner discretion. We are very, very discreet in everything we do, and I think that resonates with the diamond industry in general. We still have a traditional business of mazal and bracha, but when you see something like this, it shows that 2 entities saw the value of basically one purchasing the other, in this case, or merging, or basically collaborating. And when you do that, then it creates 1 + 1 creates 3. So I think the fact that it was published and everybody sees that it can happen will create a thought process for many companies around the world. Maybe I should look at maybe to purchase companies, small companies that have great sales and great marketing. I'm a great manufacturer. Or companies that have great marketing and sales, but they're lacking the origin aspect and the provenance aspect. So if they collaborate with someone upstream, they will do it. And this is exactly, to be honest, where we focused in the last year, because I think this is the best opportunities we see in the diamond industry. And that's why I think this deal would open up the market for more like this.
Is this made harder by the fact that the midstream is dominated by family businesses?
Yes, I think it's hard because I don't know if family business is the right reason, because you can have a family business that is a corporation. You have many entities in the industry in India that have become corporations. So yes, the family works in the business, but they're all executives. They all have very, very strong business essence in their companies. But I think it's more because of the, again, traditional ways of doing business in our industry. And the traditional ways is all very, very secretive. Everybody are trying to protect their information, protect their business so nobody else takes away. And again, if you do a good service, if you do a good product, you shouldn't be afraid that other companies will take away business from you. Because if you do the right thing, then people will stay with you, will come to buy from you, whether it's a service or whether it's diamonds. And I think, again, today, when companies become more corporate-like and more business-oriented, because they have no chance, if they stay like they were 20 years ago, they will not survive. They have to change their ways. They have to become more business-oriented. They have to become more looking at every aspect of their business and extracting value. And if they don't do that, then they will disappear. So this creates new way of doing business, new companies that will provide the base to do these consolidation. And we always talked about consolidation. I remember De Beers doing 15 years ago that we believe that the industry will have more consolidation, and we saw here and there. But I think in the last year, because of the problems in the industry, we're seeing it more, and we'll see it much more as we go forward.
Does the path from mining to retail need to be shorter?
I think it is short already. If you compare again to 20, 30 years ago, you had huge polished wholesalers that have disappeared from the market. It's short in the sense that you have the producers, you have manufacturers, and you have retailers and brands. You don't have all those middlemen that you had in the past. Most of them disappeared. You still have some and if you do have some middlemen between the manufacturers and the retail, usually it's because they do something exceptional. They do something very unique that is very hard to imitate. And that's why they're still there. You see that a lot in the watch industry. You have companies that have been there for 70 years that give exceptional service to the watch brands. So the watch brands likes to work with them and they buy from the manufacturers. Whether that will continue, I don't know. And the reason why not is because retailers and brands need to, I'll go backwards. Lab-grown has created a problem for retailers and brands who are telling a story to consumers that they need to tell the story somehow in a way to persuade customers to buy natural versus lab. That's why the natural word has become much more important than the past. In the past, natural, obviously it's natural. There wasn't any lab grown. But today, natural, the word natural is becoming a much more important element in selling the story to consumers. And when you see that, then origin and provenance become a much, much more important element. It's still a push, it's not a pull. Consumers not come to the store and say, where the diamonds come from? Almost no one would tell you that they do that. But the retailer have to persuade them why to buy natural versus lab, because it's more expensive. And the reason is because it comes from the ground, it's been there for billions of years, it helps communities. And if retailers, and again, we're working with one retailer to bring them to Botswana, to see the mines, to meet the producers, to meet the communities and the manufacturers over there, and to see the actual people from Botswana manufacturing the diamonds. And when they see that and really feel where the industry is going, and that will help them build the supply chain management. And supply chain, they all have great suppliers. But I think that once they talk directly to producers, understand the value of extracting rough from the ground and what type of rough would be there as mines change their own strategy, it will help them make decisions on how to build their supply chain going forward, especially if they're looking for a premium product like the brands and origin. Now, but also they will see the communities, they will come to Botswana, they will see the mines, they will see the people in Botswana manufacturing and working, and how the whole diamond industry is actually helping the communities sustain themselves and grow. And that will resonate with the marketing people to build that story that they need to bring to consumers in order to sell the natural diamonds. And you see that more and more. You see pilots going on, and you see more and more elements of provenance and origin. And I think we'll see it much more as we go forward. De Beers are really pushing for this because they see the value in both elements of the industry. Also, government of Botswana, ODC, it's part of their strategy going forward to promote Botswana. And I think if you look at the landscape of the world, obviously Botswana is one of the major producers, but also it's a good story. They just had elections a month ago, 2 months ago, and it was a true democratic country that the elections proved how democratic and how of a country it is for the people. Because there was a ruling party for 50-something years, I think 58, and everybody believed that the ruling party will continue. And not only that the opposition won, they won by landslide. Not only that, the ruling party left with very gracious ways, did a transfer to the new government, and that shows the world, economic world and regular consumers, that it's a great country. And I think when you look at that, then the story can be told differently when you sell diamonds. So to answer going back to your question, yes, it needs to be shortened. Not so much taking out manufacturers. The big manufacturers, you have to have them. Their expertise in buying rough, sorting rough, manufacturing and selling the polish and doing jewelry is something that nor the producers or the retailers could ever do themselves. Some do, Signet, Charles Taifuk, Tiffany's, but most of them don't want to reach that. So you still have to have the middle entity, but if I look at it as a triangle, those three need to work much more closely together. And again, this is where we're going and where we're pushing.
So we talked about lab-grown diamonds in terms of how it relates to the natural industry. We're focusing on lab-grown in its own right. What do you see as the future for that sector?
It's not $1 million question, it's the $1 billion question, I would say. Lab grown, again, I going back to what I said before, is such an interesting industry. It's again, we would teach about it in business schools, in history. We speak to many financial entities in the world who invest in the lab grown space, and they keep coming to us to ask about the industry and to ask how we see the lab grown, like you're asking, and always at the end, there's kind of a pause. Okay, so what do we do? Like, okay, so is it good? Is it bad? Like, should we invest? Should we not invest? And I always said, it's not a simple answer. The lab-grown space is difficult because in one hand, you have huge consumer demand, but on the other hand, the economics are still not clear how you make money in this space, especially when you go upstream, which is contrary to the natural space, when you go to the producers. The producers fighting one another to reduce costs and bringing the product to the wholesale market at a really, really low price. That creates a lot of problems for producers, how they can add value, because you have to invest hundreds of millions of dollars to create those huge factories that produce. People think you can put it in a micro oven and get a rough diamond for lab grown. It's not that simple. You have to invest hundreds of millions of dollars to have thousands of reactor machines to create the lab grown. You have to have scientists. You have to have people to actually develop the technology and work on it all the time. It's very expensive business to be in. Now, we saw so many companies going into it, especially in India, and flooded the market with diamonds, with lab grown, and that's why we saw the price decrease, 90% decrease in prices in a year and a half. No industry has experienced something like this in history. And we're in the aftermath. And in the aftermath, you have producers going bankrupt or leaving the industry. You have producers stopping the development. So they were planning to buy 500 more reactors. They stopped. And now what everybody are focused on is two things. One is continuing to develop the technology to reduce cost and get a better product, better color, better clarity. And two, marketing and sales. Now, if I go back to Lucix, You look at also you look at other Washington Diamonds, and you have other Indian entities who left basically, who were very promising, but they had to step out. And I always say, because you can't be a technology company in a diamond industry. You have to be both. That's why consolidation is so important in the industry, also in lab grown. You have to see yourself as a diamond company, not only as a technology company. And once you see yourself that you're in a diamond world, you have to have that expertise. And if you don't have them, then buy them or merge with someone who has them. You take companies like even Phoenix. They do everything. They grow diamonds, they polish them, and they put them in jewelry. And they're diamond companies. They know what they're doing, and they're doing it probably right. And that's why they bought Lucix, because it was a good business opportunity for them to grow. Now, if you go on the midstream, those who buy rough and polish, they still have a business because there's very good demand, and they're buying the rough cheap, I would say, because they have the power. The buyer has the power, again, contrary to natural. So actually they have a business because demand is very, very strong. But again, it's difficult. Why? Because as prices going down, obviously their stocks are going down. So they have to really watch their stock levels and what they're buying, and sell very, very, very quickly, so they don't get stuck with expensive stocks. Look at retail, we spoke about before. They have their own problems. So if you take all of that, I think consolidation is a must. I think we have to have producers of rough lab-grown working with retailers, merging with retailers, retailers buying lab-grown producers. Whatever will happen, but they will have to work to it. So producers will have to manufacture polished, most of them, and sell it to retailers. You have a company like Diamond Foundry. They're selling rough, right? They're not polishing, they have a rye, and they're the biggest in the world probably in production terms. And it's a great company. But again, when you look at the future, selling rough, would it be sufficient enough in order to sustain that value? I don't know. And this is the reason that producers like Diamond Foundry and others are also putting a lot of effort in developing the next industry, deep tech we call it, semiconductor business. Because we all understand that that's the multi-billion-dollar business for the lab grown. So in parallel to the gem diamonds, they're working on this. And whoever will succeed there and reach there first will probably make a very, very good business to the hundreds of millions of dollars they invest in their production.
Right, I just noticed last week that if you go onto the Diamond Foundry website, you wouldn't actually know they were a jewelry company at all. You think they were a company purely focused on industrial diamonds.
Right.
We did have a guest on our podcast a couple of months ago, or a few weeks ago actually, Eddie Levine, and he made an interesting observation that he believes that the rush into the real goal of lab-grown diamond producers is to produce for the AI demand, the demand for chips that will come from the AI industry.
Mm-hmm.
And selling diamonds for jewelry now is just a way of making some short-term income while these companies work on developing those technical capabilities. Do you agree with that?
I agree in partly. So you have those companies like Diamond Foundry, and as you said, you go into the website, it looks like they're a technology company, that all of their essence is to reach that holy grail of creating the perfect lab-grown diamond to reach the semiconductor, chips, AI, whatever it is, industry. And once they reach that, all the manufacturing, all the factories will probably be switched to growing those diamonds, which are different to the technological industries, rather to the gem industry. But as he said, rightfully so, in the meantime, they have reactors, they need to get cash. So selling rough is, as long as your cost is low and you can make a profit, then it's a very good way to sustain your business while your R&D is working on the future. But you have companies who might have an R&D section working on the technology, but their essence is a diamond company. Companies in India who are diamond companies, and they're investing heavily in lab-grown, and you have some very large companies in that space, are geared towards gem. They're opening retailers, they're opening retail divisions of online sales. They have a polish division, they have rough division, they're doing jewelry. They're looking at the whole diamond spectrum and trying to extract the most amount of value from the rough they manufacture. And I think they're doing well. And I think in the future, there will be much less competitors in that space. And you'll see very large companies controlling the gem part of the, and you also see smaller companies who are, again, doing something very different, very creative, growing diamonds in a different way, doing things that are very exceptional in color, in shapes, whatever it is that will resonate with certain elements of the industry, and they will concentrate on gem and not do anything with technology, and they'll make good money. So you have both, but the big companies, the technological companies, and also the companies that are outside of India definitely focus more on technology.
Right. So about 5 years ago, the line was that there was a severe shortage of human capital in the synthetic diamond industry. There weren't enough scientists that knew how to develop the product. Is that still the case?
I don't think so. I think you have enough scientists today that understand in lab grown, that understand how to grow labs. You saw the Indians really, really putting effort and funds into growing that scientific knowledge, and every company on its own to reach the technology. And you see the results. Most of the growers in the world, in China as well, we haven't spoken about China, but China is a big catalyst for lab-grown diamonds, and you have HPHD, but it also has CVD growers in China. They are putting a lot of effort in the technology part, in the scientific element of creating a better product, and they reached. You have many companies who already have DE colors, VVS quality. This is, I know from the Lusix in the beginning, they're really struggling to reach that quality. They reached it at the end, but Indian companies and Chinese companies have reached it as well. So it means that it's difficult, but it's doable. If you put the money and the effort into the right scientific minds, you will get to that technology. It's not something that is beyond reach, I would say. And this is what caused the decrease in prices as we saw in the last few years.
So what's your prediction for the balance between retail prices of lab grown and wholesale prices? Are they in balance yet?
They're not in balance, obviously, because wholesale prices have reached a really, really low price. And there's fast competition in the wholesale space. Retailers are taking advantage of it because on one hand, they're selling still comparatively higher prices, so they're making a large margin, and they're squeezing the wholesale market into buying better and buying cheaper. But I think the good thing is, in the last 6 months, we've seen that the wholesale prices has reached a bottom, a very low price maybe compared to what it was a year ago, and nobody's happy about it, but at least it's stable. At least you can start working. And yes, there are pockets where it's still going down or even went up a little bit, but it's very small elements of the industry. Most of it is kind of reached a point where we know what the price is. Now we need to start working and creating the business. Retailers have a different problem. They have to sell in certain price point to justify putting that jewelry piece in their store. So whether it's selling a 1 carat, is selling in the stores for $1,000 or $1,500 ring. And yes, if you compare to wholesale prices, it's a huge gap. But still, when you take the monetary aspects, so it's not a lot of money to justify holding all the stores and the marketing and the logistics and so on. And as prices of retail continue to decrease, and they probably will for consumers because the competition is growing all the time, some retailers will probably decide to get out of the lab-grown space. And there will be other retailers who will capture that market share, like Walmart, like Costco maybe, and other entities of online sales. And we'll see a shift of where you can find lab-grown in the retail space, because as prices will decrease, and they will, we will see that effect on how retailers and where retailers are selling their lab-grown. I don't think there will ever be a equilibrium, but there will be a bottom also to the retail sales, that they have to justify selling a diamond with all the expenses around it.
What is the typical wholesale price for, let's say, a 1 carat commercial lab-grown polished diamond? Would it be around $100 a carat?
No, I think $100 is too low. I think $100 is for low quality. If today you have the colors, because everybody reaches probably VS quality. Some reach VVS, SI is not interesting in the lab space because, again, why? Just manufacture the diamond, take out the inclusion and create a VS. And most technology companies can reach that. The color is different. You have a spectrum of D and down. So $100, I think, if you go down from H color, then the demand for those type of lab growns in the consumer is very low because, again, for that type of money, when you go into the store, then the whole essence of persuading you to buy versus natural, because you get a great color, you get size, and so on. So no, I think $100 is a bit cheap. I think we're talking, it really depends on, you have the 4 C's, so obviously, but on average, I would say you're talking about $130, $140 per carat. And I'm not talking D color, I'm talking probably EFG colors, VS quality, of course, nice make.
Right. Moving back to natural. So you had many years as a De Beers broker. How has that role changed over the decades?
Everything has changed. De Beers has changed. The industry has changed. So, and this is part of the reasons I decided also to leave 3 years ago, because again, I felt that many people in our industry are still many companies are very traditional and very in the way they do business. And De Beers, we also saw this are making changes internally and externally, and everybody needs to adapt to those changes if they want to continue being a De Beers broker, representing sightholders, and also the sightholders themselves need to adapt with that different strategy. I remember, in 20 years ago when they introduced the IFRS, every sightholder have to have audited financial statements by top 20 accounting firms in the world. Nobody understood even why they want this, why are we doing this, why do we need to do this? It was very difficult to take the companies and move them to that space. But De Beers saw that in the future, banking regulations, world regulations, KYC, all this will really affect the sightholders and the industry. And if they don't do this, it will be very difficult for them to sell the rough diamonds to those entities. So it was very, very difficult. We made those changes. So the same for go to broking. Everybody asks me, I'm a De Beers, one of the few De Beers brokers representing sightholders to De Beers. But I don't see myself as a broker in the sense of a broker if you look in the dictionary. A broker is someone that does a deal between two entities or make sure that those entities do the right business together. Today, everybody evolved. Sightholders today, in the past, De Beers kept information very secretive. It was very difficult to know what De Beers want from the sightholders and how they make decisions on allocating their rough. Sightholders were concentrating on manufacturing, and sales, of course. They weren't conglomerates. They didn't have executives. They didn't have the mindset to manage stakeholders. This was the broker's job. That's what they did, and they did it well. But as De Beers changed, as the industry changed, De Beers are much more open. They're much more transparent. They work very closely with their sightholders. They have CAMs and VPs around the world in the centers working together with the sightholders. And also the sightholders have become true companies in the sense that they have people educated. A lot of the Indian companies, their children went to learn at Harvard and Columbia and very, very good schools around the world, came back to the business and they bring business knowledge. So it's much easier for them to manage stakeholders like De Beers. So where I see, now of course, every company and every executive, they have a mandate to do when they wake up in the morning. They have to do their job. Now, everybody in the people who work in the sightholders and the companies, they have a day job. De Beers is not the day job. The day job is selling, is marketing, is manufacturing. My day job is De Beers, and I must say also ODC, because as I told you in the last year, I consulted ODC, and I think there's great opportunities to work with ODCs as well. I tell my clients I wake up in the morning and I think about your business and where De Beers business is going into the future, and make sure that we work in the right way together, very collaborative, not as a gateway, not as someone in the middle, together, in order to create the value that De Beers are expecting from the sightholders and sightholders need from De Beers. And with the change of De Beers strategy, as they go forward, and they're making very large changes, and sightholders need to focus on that and make sure they work with De Beers and internally in their own business in order to capture that business opportunity. And in that respect, that's how I see my job is today. And Lexa's job is to consult them, to work with them. I always say, treat me as a part-time executive in your company. And once I'm there, and once I learn the business, then I can help you with the De Beers. But again, very different to what it was in the past, but help you manage that stakeholder, but also create business opportunities, work as a business development executive in your organization in order to create business as a whole. And that's, I see the essence of broker. I'm not a diamond tier. I don't know how to raise a diamond and tell you what it's worth, if it's VS or SI. But I know the diamond industry very, very well, from retail to mine. And I can really look at the industry in a much more holistic way and strategic way to help facilitate that De Beers sightholder relationship.
From the outside, at least, the biggest change going on with De Beers and the sightholder system is that they've said that they wanted to reduce the number of sightholders. And I've seen it explained that this is really just De Beers anticipating that sightholders are going to quit, they're going to give up their site. And De Beers is just trying to anticipate that and make it look like it was their decision. What do you think of that?
De Beers are making fundamental changes in their business. And one of those changes is reducing the amount of sightholders. And I must say, in the ITO that was announced to next year, some sightholders lost their ITO. There's still sightholders for the next year. But the reason is those sightholders knew that it's coming. It wasn't a surprise because there are thresholds that they need to apply. Now, some companies make a business decision that they don't want to make that effort to reach those thresholds because it's not right for their business. And that's exactly what De Beers are saying. They're saying, let's work together with the sightholders, let's cooperate together, let's partner together in order to make value for both sides. Now, if some companies don't see that value, or they don't think that they're willing to make that effort, business effort, in order to stay a partner with De Beers, then eventually there will probably not be sightholders. And it's okay, it's part of the business cycle. It's not easy for some of them. They've been sightholders for decades. But again, businesses change, they understand it, De Beers understand it. I do think that at the end of 25, there will be less sightholders. De Beers have said it. But I do think that those sightholders who have great businesses or would think outside of the box, create something that is more creative and interesting to De Beers, by partnering up, by bringing downstream players into the fold, then this is exactly what De Beers are looking for, and those companies will stay on going forward to 2026.
Eyal, thank you. It's been a very interesting discussion. We've spoken about natural and lab-grown, retail, polished, rough, the whole supply chain, and we've heard some very interesting insights. I'm very grateful you've joined us on this podcast, and thank you for sharing your time and your knowledge.
Thank you very much for having me, Joshua.